This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Market catalyst, investor attention is squarely on tomorrow's employment report and whether it will show what many economists are starting to believe, that job growth is slowing. New normal, why Americans just are not eating out like they used to. Location, location, location. You take a picture, you post it on social media, but are you also revealing personal information that you'd rather keep private? Those stories and more tonight on Nightly Business Report for Thursday, August 4th. Good evening, everyone. I'm Sue Herrera. Tyler Matheson is off tonight. The job market has been a bright spot in an economy that's seen lackluster growth. Employers have been creating jobs at a healthy clip for years, but today, just one day before the July employment report is set to be released, there were two setbacks for American workers. First-time applications for unemployment benefits rose by 3,000 last week to a seasonally adjusted 269,000. We also learned today that there was a rise in layoffs last month, and tomorrow we may get answers to some pressing economic questions. Hampton Pearson has more.
Sagging energy prices drove layoffs higher in July, a 19% increase over June. Outplacement firm Challenger Grain Christmas says the cuts came from large employers.
Those big oil companies, ConocoPhillips, made a big cut this month, as well as the equipment companies like Halliburton continue to cut jobs as they react to the real amount of business that they've got to handle.
Despite the setbacks, leading economists still see a labor market healthy enough to support economic growth for the rest of the year without the volatility of the last 2 months. There was June's blockbuster growth of 287,000 jobs, following a near wipeout in May when employers added just 11,000 workers to payrolls. The consensus forecast calls for payrolls to increase by 179,000 jobs, with the unemployment rate falling to 4.8%.
This would be a second strong jobs report following the weak reading in May, and we think it would give the Federal Reserve comfort about the state of labor markets and its outlook on the U.S. economy.
Monetary policymakers will have tomorrow's July report, plus another one for August before their next policy meeting in mid-September. That data will help determine if the Fed raises rates or changes course. For Nightly Business Report, I'm Hampton Pearson in Washington.
While investors wait for the next Federal Reserve meeting, the Fed's counterpart in England made an historic move, cutting its main interest rate to its lowest level ever. And the Bank of England didn't stop there. Jeff Cutmore reports now from London.
There were a couple of firsts in this report from the Bank of England today. The first time we've seen interest rates cut in 7 years, but also the first time we've seen such a dramatic reduction in growth expectations. They're now talking about 0.8% GDP growth for full year 2017, and that's a very radical departure from the previous forecast of 2.4%. That goes some way to explaining why we had more than just an interest rate cut at this meeting. £70 billion of stimulus introduced in the form of a corporate and gilt bond buying programme. That will go some way, perhaps, in calming jitters around what the post-Brexit UK economy is going to look like. Mr. Carney was asked several times in the press conference whether he thought helicopter money might be a good idea or whether UK rates may indeed have to go negative. He said he is no fan of negative rates, but the bank has signalled that rates are likely to go lower again before the end of the year. This is Jeff Cutmore at the Bank of England, the Nightly Business Report.
Britain's vote to leave the European Union is not only prompting the Bank of England to make big moves, but it might also deter British tourists from taking that vacation here in the U.S. And as Aditi Roy reports, American businesses are paying close attention.
It's travel season in the U.S., and that means the British are coming. The U.K. sends more overseas visitors to the U.S. than any other country. Last year, the Commerce Department says Brits spent more than $4.5 billion in the U.S. Now, with Brexit looming and the sterling weakening against the dollar, some are worried that the U.S. may be too pricey for U.K. tourists. But in the travel industry, opinions seem to be mixed. In its earnings call today, TripAdvisor is saying Brexit is partly responsible for softness in June and into July. But Intercontinental Hotels says it expects currency fluctuations to have only a small impact on its results. And last week, American Airlines told analysts on its call that while they haven't seen any short-term impact of Brexit on the company's revenues, they expect currency changes to have a negative effect on the airlines, adding that down the road, it's the business traveler that they'll be watching more closely. Looking forward, the Travel Trends Index, which gathers data from airlines, hotels, and travel sites, says international travel will be slightly lower in the next 6 months. The U.S. Travel Association says that historically, the growth in tourism from the U.K. has been tied to currency changes between the two countries, and that could have some in the travel industry watching the exchange rate closely. For Nightly Business Report, I'm Aditi Roy.
So what will all of this, Brexit's impact on tourism in the U.S., to the rate cut by the Bank of England and tomorrow's much-anticipated jobs report mean for your investment portfolio? Kevin Caron is the portfolio manager with Stifel's Washington Crossing Advisors Group, and he joins us now. Good to see you again, Kevin. Welcome back.
Good to see you, Sue.
Let's start, first of all, with what the Bank of England did. One, were you surprised, and do you think they're going to have to do more?
No, I think this was delivered pretty much on script. The Bank of England needed to do two things. They needed to assure markets that they were there to support what might be a weak economy. And by the way, we haven't had a lot of data to judge the path of the economy.
Yes, exactly.
But then they also couldn't do more than the market expected because the country's also somewhat concerned about a weak sterling. So the market got today, I think, exactly what it was looking for.
You know, how long do you think it will be before we get some concrete data about the Brexit vote effect on either consumers or the economy? It could be some time, I would think.
Yeah, I think it's going to take some time. And there are a couple different parts of this. You will get some data on GDP within the next couple months. And in the near term, we're going to be looking at some various surveys, et cetera, to get a gauge of things. But you have to also understand that nothing really has happened yet economically. There may be a shock to psyche. There's some planning that has to be made in terms of what the future looks like. But in the last few weeks, not too much has actually changed as a result of the vote.
Here at home, where does this put the Fed? Because if indeed they do decide to raise rates maybe in September, they're going in the opposite direction of most central banks around the world.
Yeah, and that's a bit of a trick because what the fortunate thing that we have here is that we've got an economy that's doing much better than other places. We've got an unemployment rate that is coming down. We're going to be looking at the jobs number tomorrow. You mentioned it earlier in your segment. We're also going to be looking at the inflation rate, and the Fed's going to be looking at the inflation rate, which appears to be stabilizing. If you look at where we are annualized last few months of core inflation, you're above 2%. So inflation, employment, they look pretty good. Not much slack in the economy. That would suggest the Fed should be raising interest rates, but that's not where the rest of the world is. You look at Europe, just about every major economy there has negative short-term interest rates, and that's creating some potential for volatility in currencies.
So are you changing your portfolio mix at all? And for those at home, where would you put money to work given the backdrop we just set up?
Yeah, well, not much has changed because we've been advocates of staying with the dollar, staying with the U.S. economy because we think we're the best game in town. We think the growth here is the best, as I mentioned, and having a strong dollar to boot isn't so bad. So we're staying with that posture in terms of sectors. We do like healthcare. There's been a little bit of underperformance as a result, perhaps, of the election coming up. We think there's some good balance sheets and values to be had there. Industrials, same thing. And I would even say that gold is something that we put back as a small position in portfolios earlier this year, basically as a hedge, and we think the valuation has gotten somewhat better.
All right. Thanks for the advice, Kevin. We appreciate it, as always. Kevin
Thanks for
Caron
having me.
with Stifel's Washington Crossing Advisors. Well, stocks were pretty quiet today following the Bank of England's rate cut and ahead of tomorrow's July jobs report, which some hope will provide the market with a little more clarity. When all was said and done, the Dow Jones Industrial Average fell just about 3 points to 18,352. The Nasdaq added 6. The S&P 500 was up fractionally. As for oil, domestic crude rose more than 2.5%. Still ahead, why a troubling trend may be brewing in the restaurant industry. It was a lackluster quarter for Viacom. Profit tumbled at the media company, but the results were better than what analysts had been expecting, and that helped send shares higher. But its quarterly results are being overshadowed by a vicious and very public fight between Viacom's CEO and the company's controlling shareholder. Julia Boorstin reports.
This is one of the most unusual boardroom battles we've seen in years. Viacom's founder and controlling shareholder Sumner Redstone is trying to fire his protege and longtime friend, Viacom CEO Philippe Dauman, while Dauman is arguing that Redstone is incompetent to fire him. This morning, Viacom reporting modestly better than expected earnings. Dauman defending the company, saying the results were impacted by underperformance of the Teenage Mutant Ninja Turtle sequel, that its network showed sequential improvement and completed a successful upfront. But Dauman is under fire for his management of Viacom.
There's still enormous heat on Philippe Dauman. They pre-announced a bad quarter a few weeks ago, so they marginally beat those lowered expectations. If you compare what they did this quarter to a year ago period, it's obvious this company is still in difficult position.
These mixed results come on the heels of reports that talks to settle Redstone and Dauman's legal issues fell apart. Now the question of who controls Viacom's future, Dauman or Redstone, will be decided by judges in 3 states in October. A Massachusetts judge will hear Philippe Dauman's suit over Redstone's mental competence. A Delaware judge will hear lead independent director Fred Salerno's suit to block his, Dauman, and 3 other directors' dismissal from Viacom's board. And in California, a judge will hear Redstone's action to validate his decision to replace Viacom's directors. On Viacom's earnings call, Dauman acknowledging that these legal battles have been an overhang on the stock and his push to sell a stake in Paramount. But now he says he's optimistic.
Last week, courts in Massachusetts and Delaware rejected motions to dismiss, allowed discovery to proceed, and scheduled trials to take place in October. We view these favorable court rulings as positive steps that move us ahead to a resolution.
Redstone's National Amusements issuing a statement today taking a jab at Dauman, saying, quote, Dauman is the 3rd highest paid CEO in the United States and among the worst as measured by pay for performance. Including his pre-negotiated golden parachute, he stands to receive almost $500 million for a tenure that has seen the market decline of one of the nation's greatest media companies. As the barbs continue to fly, it's clear the battle for Viacom is far from over. For Nightly Business Report, I'm Julia Boorstin in Los Angeles.
The owner of Burger King and Tim Hortons reported an unexpected fall in revenue. Restaurant Brands International says unfavorable exchange rates along with slowing sales at existing locations weighed on its quarterly results. But those lower sales were offset by cost cuts, and that helped send shares of the parent company Restaurant Brands higher on the session. But it's been a tough second quarter for other restaurants and fast food chains as well. Consumers have been going out to eat less, in part because of cheaper grocery prices. And as Susan Lee reports, some say this is the new normal for that sector.
Whether it's burgers, burritos, or fried chicken, Americans are not eating out like they used to. Lower prices at the pump, aggressive value deals, and even new menu items are not enough to get more people into restaurants. This is what's being called the new normal in the meals business. The NPD Group has been tracking sales receipts for the industry for decades, and they say that foot traffic stalled in March this year, just before U.S. consumer confidence started to wane. The sector is now growing slower than historical trends. NPD forecasts industry traffic will only grow an anemic 0.5% each year for the next 6 years.
We've never been able to find a strong correlation between movements in gas prices and same-store sales and traffic. There's a lot of other factors, so I'm not convinced that the gasoline prices really play that much of a factor as much as wage inflation and growth in jobs. I think those are the two factors that investors should look at.
Living costs are going up faster than wages, which is hurting consumer confidence. Also, high college debt being paid for by both students and parents, and the millennials' lack of disposable income, all contributing to a slowdown in restaurant visits. And there's another factor keeping average folks from dining out, according to McDonald's CEO Steve Easterbrook on the company's earnings call.
There is a widening gap between food away from home and food at home, where the commodity decreases are being passed through by the grocers, so the food at home there's value to be had for families there, whereas eating out there is a price inflation environment.
McDonald's, Burger King, and Chipotle have all seen a slowdown in sales growth in this year's second quarter, but things may be turning around.
They've seen the sales slowdown for sure. It's been kind of clear from first quarter into the second quarter, so it's there. But again, it may reverse itself. There is some evidence that we've had an improvement in the month of July. Maybe even it might be slight, but we have seen an improvement in the month of July. So who knows if this is going to continue.
The NPD Group paints a more pessimistic picture, with sales set to grow even below the years since the global financial crisis. For Nightly Business Report, I'm Susan Lee.
A sharp drop in attendance hurts SeaWorld's results, and that's where we begin tonight's Market Focus. The theme park operator said fewer tourists from Latin America and an overall downturn in the Orlando market, which is home to its biggest park, contributed to a nearly 8% drop in visitors. Revenue for the quarter also fell, missing estimates, while profit rose and was in line with targets. SeaWorld also cut its yearly profit guidance. The shares plunged 13% to $12.88. Kellogg's revenue fell below expectations as the maker of Eggo waffles and Frosted Flakes saw continued weakness in its cereal brands. But the food giant did post a jump in profit thanks to cost cutting. Kellogg also raised its yearly earnings outlook. Shares were higher by more than 1% to $82.42. MetLife will cut $1 billion in costs by the end of 2019, and job losses will be part of that plan. The news follows a disappointing earnings report from the nation's largest life insurer, in which quarterly profit fell 94%. MetLife shares fell nearly 9% to $39.54. LinkedIn reported higher than expected revenue thanks to an increase in premium subscriptions and sponsored content. The professional networking website also beat analyst profit estimates earlier this month. The software giant Microsoft announced that it would buy LinkedIn for about $26 million in a deal that is expected to close this year. Shares were flat following the earnings and closed the regular session down 25 cents to $192.01. Nike, the world's biggest sportswear maker, is getting out of the golf business. The company says it will stop making clubs, golf balls, and golf bags so it can focus on its shoe and apparel business. But is this move by Nike another blow to the game of golf, where the hits just seem to keep on coming? Will Gray is associate editor at thegolfchannel.com, and he joins us now. Good to see you, Will. Welcome.
Thank you. Good to be with you.
What impact do you think this will have on the space with Nike exiting?
Yeah, certainly interesting timing given the golf season is right at basically its peak time. But I think that it's going to create an opportunity for the other equipment manufacturers in golf in terms of the long-term health of the game. I don't think that Nike getting out of the equipment space is necessarily going to have a huge impact. Remember, they're still going to be very involved in golf. They're just going onto the soft goods side. You'll still see plenty of swooshes on golfers, both on the men's and women's side.
Yeah. Who do you think it will benefit? I mean, we saw Callaway Golf and its stock move sharply higher today.
Yeah, Callaway certainly had a big first day of trading after the Nike announcement, but a company that I have my eye on is PXG. It's run by Bob Parsons. They've only been making golf clubs for the last year or two, but they're really in a position to make a big splash. They've had a couple of big names on the PGA Tour that they've signed this year. I think that when you're looking at where Nike's athletes and golfers could sign in the future, PXG could be a very intriguing destination.
Yeah, you know, this follows Adidas saying in May that it was also going to exit that part of its business because it's been an underperformer, and this part of the business was an underperformer for Nike. But what does that say about the state of golf and the state of the game?
Yeah, I think the state of the game, people are still playing golf. We saw last year 2.2 million people tried golf for the first time. That's the most and the highest number since basically Tiger Woods came onto the scene. The decision by TaylorMade and Adidas to kind of part ways or for TaylorMade to be sold really shows that golfers are going to move into an a la carte model where you're not necessarily going to see as many players going head to toe with all apparel and all clubs. You can see a deal like Jordan Spieth has where he has Under Armour for his apparel and then he has Titleist clubs.
Yeah. The game itself, one of the things that I hear is it takes a long time to play the full 18 holes. Is golf itself looking at its business model, for lack of a better word, and perhaps making some changes to help the game?
Yeah, for sure. I think that creativity is the key. We're seeing companies now propose 6-hole games, 9-hole matches, things like that. We've seen foot golf on the rise, where you're playing basically a game of soccer on a golf course. But overall, golf is still moderately on the rise. The National Golf Foundation did a study that showed last year rounds played were up almost 2%. This year in June, they're already up about 3%. Junior golf participation is on the rise from 2.4 million in 2011 to 3 million in 2015. So while this kind of could seem like a negative for the golf industry as a whole, participation does seem to be at least slightly on the rise.
On that note, Will, thanks so much. Will Gray with thegolfchannel.com. Coming up, why a simple photo posted online could reveal personal information you'd rather keep private. Startup activity is rebounding, and there's a new demographic taking the lead when it comes to opening new businesses. Kate Rogers has more.
A new report from the Kauffman Foundation finds levels of entrepreneurship amongst both women and millennials are on the rise this year. The foundation's startup activity report for 2016 finds that the gender gap is closing in entrepreneurship, with women now making up 40.6% of new entrepreneurs compared to men at 59.4%. Millennials ages 20 to 34 accounted for 25% of new entrepreneurs. That's up from 24.7% last year. But this number is still well below what it was in 1996 when the index started at 34.3%. Researchers point to student debt as a big factor in this slow growth trend. Another good sign, more startup founders are considered opportunity entrepreneurs, meaning they're launching businesses because they see opportunities in the marketplace to do so, not because they're unemployed and doing so out of necessity. Women are also more likely to be opportunity entrepreneurs than men. Now, overall, the startup index climbed in 2016 for the second year in a row. That translates to about 550,000 new entrepreneurs each month during the year. This data, though, it shows a different trend than a recent report we highlighted on this show, tracking slower growth in U.S. startups. However, the Kauffman Foundation measures entrepreneurship differently than other researchers and doesn't actually count you as a business owner until you quit your full-time job. For Nightly Business Report, I'm Kate Rogers.
Posting and sharing photos online is something many of us do without hesitation. Yesterday, we told you how businesses are tracking your public updates as a way of increasing awareness of their brands. But there's more to it. Your posts may seem innocuous, but they could actually be leaking sensitive information about you or your business. And according to the experts, you don't need to be an experienced hacker to find it. Andrea Day has the story.
I think people don't know is just how dangerous it is.
A simple photo posted online, but this one right here has a secret they may not want revealed.
if the photo you upload has GPS data embedded in it. So if I just take those coordinates and you pop them into something like Google Maps.
According to security expert Chris Agnaghi, your confidential meeting location could be compromised. And that's not all.
What organization you're visiting, what business you're in, what kind of contracts you're working on, which is a really serious matter.
It's called geotagging, where your location data is automatically embedded in photos. And if you leave your smartphone satellite location on, you could be handing out your exact location with every post on social media.
You can easily follow someone like that completely around the globe, wherever they are.
The info leak, potentially exposing your business secrets and personal life too. Agnaghi takes the coordinates from this photo and puts them into Google Maps. Seconds later, finding the city, neighborhood, even the exact house where the shot was taken.
They can geolocate your house. They now know because of Facebook you're overseas and your house is unattended.
And across the country, criminals are using social media and geotagging to target unsuspecting victims. This man in California, Arturo Galvin, accused of finding his 33 burglary victims through photos posted on Instagram. Most of his alleged victims were students. Investigators say he used the GPS coordinates in pictures to track where victims lived, and then came by to grab electronics, wallets, and more. Galvin pleaded not guilty and is awaiting trial.
That some stranger can find a picture on the internet and then be able to geolocate our home. Social media is a great tool, but it can also be a huge, huge danger.
And he says geolocations are being used in apps in new ways every day, like the wildly popular Pokemon Go.
It's just a game, but it uses your geolocation data as part of that game.
And he says the amount of information hackers can find is anything but a game.
They can find out where you are and what you're doing at any point in time. You can take a risk on your contracts, your business negotiations.
So how can you reduce the risk? Well, it's actually pretty simple. Just turn off the location access in your camera app. Go into settings to make the change. And remember that most devices come with this automatically turned on. I'm Andrea Day for Nightly Business Report.
And that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us. Have a great evening. We'll see you tomorrow.